Hi, Ray. How are you doing?
I am doing very well, Paula. How are you doing?
I'm doing well. Thanks for asking. So, today we're going to discuss how Canadians can finance purchases in Jamaica. So, we are going to ask you a few questions and you're going to explain the process to us.
Ray MacMillan is a mortgage professional and real estate investor who has been actively involved in the investment, banking, and lending industry since 1994. After graduating from the University of Guyana with a degree in geography and economics, Raymond migrated to Canada in 1989. Raymond first entered the financial industry in 1994 when he joined Standard Life Assurance Company as an investment advisor. After a few years there, he moved over to RBC Insurance and then to CIBC, where he spent some time as a financial advisor. Ray's primary role at CIBC involved providing clients with investment advice and underwriting personal loans and mortgages. With the extensive knowledge and experience he received at CIBC, Raymond decided to move full-time into mortgage brokering in 1999. He opened the doors of the MacMillan Group in November 1999 and has been licensed as a mortgage professional since then. With hundreds of millions of dollars worth of residential and commercial mortgages funded since 1999, Raymond's unique experience and knowledge allows him to advise clients on all types of mortgage transactions. The team currently consists of both realtors and mortgage brokers who are multilingual professionals. Included in this team is his eldest son, Stefan, who joined in the summer of 2015. Through the years, Raymond has received several industry awards. He has also managed and coached two members of his team to the status of Top Mortgage Volume Producer Awards. Since migrating to Canada, Raymond has been involved in mentorship within various segments of the community, particularly those in the Afro-Caribbean segment and at-risk youth. Once Raymond began his journey in entrepreneurship, he turned his attention to helping young entrepreneurs find their purpose. Along with 5 other colleagues, he formed the Afro-Caribbean Business Network in the fall of 2017, an organization that has the sole purpose of connecting young entrepreneurs, both in age and experience, to connect, build, and grow.
So, the first question is, what are the ways in which a Canadian resident or a citizen can access their home's equity to finance a real estate transaction in Jamaica?
That's a very good question. There are a few ways to do that. The first and most simple way is to sell your home, and that will give you access to all the equity. So if you've decided you've been in Canada long enough and you're tired and you've had enough of coal by the day we're having right now, then the fastest and easiest way, if you plan to spend most of your time back in Jamaica, would be to sell the property, take all the equity out, and buy the home of your dreams in Jamaica. The question that somebody asks is, when I come back to Canada, visit friends and family, what do I do? You stay with family here, or you get what is called a short-term rental. Now, that might not be appropriate for most people, because many folks who live here and are from Jamaica have ties in both places. They have ties here in Canada, family, kids and grandkids and in-laws and that sort of stuff. And then they've got family back in the island. The next option would be to refinance your home. And that is probably the more common approach and one that makes the most sense. Where you have a home that you've owned here for several years, it's got equity in it, and you can refinance that property up to 80% of its current appraised or market value. And that means if you have an existing mortgage of, let's say, $100,000 in your current home, and the home is worth $1 million, you can refinance it up to $800,000, providing your income and credit allow you to do that, because you have to be requalified to access that equity.
Just a quick question: does age play any part in the refinancing process?
Age should not play a part because you can't be age biased to clients. But I have seen lenders in the past who asked us to reduce the amortization from 25 to 20 years or from 30 to 25 years for clients who are extremely senior. And usually as clients over the age of 80, between like 80, 85, that sort of age.
Wow.
But for clients in their 60s and 70s, that is not usually an issue. And most of the clients who you see remigrating or moving back to the Caribbean, back to Jamaica specifically, are usually in their 50s or 60s. That's when the bug to buy a property in a warm, sunny island usually bites most of us. So the refinance is probably the easier and the more logical option. And the refinance can take two forms. It could mean renegotiating the existing mortgage, or it can also mean leaving the existing mortgage where it is and what is called an equity takeout in the form of a HELOC, which is a home equity line of credit or a second mortgage.
Oh.
Right? And again, the qualification is critical. So the income has to be there to qualify the borrower, and the credit has to be appropriate. Usually they require a credit score of 680 and higher. And then one of the options is not as common for many borrowers is what is called a home income plan or a reverse mortgage. And this usually is more appropriate for clients who are elderly and have limited income. So they're already retired. They've got a home here that is mortgage free, but they want to now buy or build a home in Jamaica, but their income here doesn't allow them to qualify for either a refinance or a home equity line of credit. So the other option for clients who are retired is what is called a Canadian Home Income Plan. It's a mortgage that doesn't require payment, that is more appropriate for retired Canadians. In simple words, it's what is called a reverse mortgage. And lenders will lend the homeowner up to a certain percentage of their appraised or market value of their home based on their age. So the older you are, the more access you're able to tap into to finance your purchase in Jamaica. There's no payment required in that mortgage. And once the person passes away, then the estate will either sell the home or renegotiate a mortgage with another lender and pay off that reverse mortgage. It's a product that is gaining some popularity today, and it is very popular among the more affluent Canadians, a bit more sophisticated.
And number two is, how does one go about refinancing their home?
The process involves, first of all, finding out the value of the property and what equity is available to be accessed. So that would include having an appraisal by an accredited or a certified appraiser to determine the property value. The next thing is to determine what the client's credit profile is, because the lender you will deal with as a borrower is impacted by your credit rating. And here we've got prime lenders like the major banks. We have alternative lenders, and then we have private lenders. So there's a lender for everybody based on their credit circumstances. And then the final option is your income. What is your source of income? Are you self-employed? Are you salaried? Or are you a retiree? Because we have to hear what is called debt service ratios. And your debt service ratio is determined by the income you have in relation to the amount of money you plan to borrow. So those three factors have to be in sync.
What is a home equity line of credit, or otherwise called a HELOC, and how does it work?
The HELOC, or home equity line of credit, is a revolving credit facility that is financed against your home. It can be in first position or second position. If it's in first position, it's usually up to 65% of the appraised value of the home. If it's in second position, the HELOC component, again, is up to 65% of the appraised value. But the total financing, if there's an existing first mortgage, cannot exceed 80% of the property value. And I'm going to repeat that one more time. If it's in second position, it can be up to 65% of the profit of the mortgage financing, but not exceeding 80%, including the first mortgage. HELOC qualification is usually a bit more stringent than refinancing. They require higher credit scores, usually above 700, and the payments are most likely interest only. So it makes it easier, particularly for people who are on a fixed income or on a pension, to afford their lifestyle without large mortgage payments. So it's a very unique and interesting product, and one that usually requires prudent financial planning, because it might never be paid off, because all you pay is the interest most of the time, unless you decide to pay more than the interest and pay down that outstanding balance. Started than a mortgage refinance. The credit score requirement is usually a bit higher, usually 700 or above. Property location is also very important. It has to be prime real estate in a major urban center. And again, the property has to have the value in order for the lender to lend against it.
Okay, this sounds very interesting. Very interesting. The next question I have for you is, what is a reverse mortgage and who would this product be more appropriate for?
A reverse mortgage is one which is registered against a home, usually of someone over the age of 55, who has limited income and sometimes not the best credit. The product requires no repayment. So how it works is that the mortgage amount is registered against the home of the owner up to a specific value, usually around 55 or 60% of the appraised value. And the amount that they will lend, the maximum amount, is based on the borrower's age. So the younger the borrower, the less money they can access. The older the borrower, the more money they can access. And the principle behind it is that your home is increasing at a certain value every year. Let's assume 4% annually. And they're lending you money at a certain rate, somewhere between 5 and 6% based on current rates in Canada. But you don't have to make any payment. So the logic is, as your home increases in value, your equity position is not really eroded. So it allows you to stay in your home without making any payments to your home. And again, this product is more a lifestyle product. It's more designed for the person who's paid off their home, who has an estate. They may have other assets. There are many taxable benefits to taking a reverse mortgage against your home, particularly if you have other investment portfolios, as opposed to taking a regular HELOC or a refinance. It is a bit more sophisticated. It's not an easily understood product. So it's usually advisable that those clients who want to take a reverse mortgage sit down with a mortgage planner, mortgage advisor, sit down with an accountant and see how best it benefits them to do what they're trying to do. It's also very important also to get the kids involved in the conversation, because there's much misunderstanding about the reverse product. One of the things that many people are concerned about is that the reverse mortgage will erode all the equity in the home. And when the person passes away, the bank or the lender owns the home. And that has never happened in Canada, because property value appreciation is usually going at the same rate as interest rates, or usually higher. So there's no real significant erosion of equity over time.
Okay, that's very informative. I did learn something right there. Last question I have for you is how important is the credit rating or score in getting a HELOC or refinancing?
But a HELOC is very important because HELOCs are usually given by the prime lenders and some alt lenders. So your credit score will have to be pretty substantial when looking for a HELOC because this is more of a prime product for prime clients. With a refinance, it's not as difficult to get a refinance done, even if the borrower is credit challenged. So the better your credit score, the more borrowing options you have. So you have access to more mortgage products and better interest rates. The lower your credit score, the less access you have to lenders and mortgage products. But what is also important is how much money you are borrowing in relation to the value of the property. So if the property is worth $1 million and you only want to borrow $400,000 against it, then it might not be that difficult, even with a credit challenge. But you may end up paying a slightly higher rate than someone who has a 780 credit score. If your credit score is higher, we get into the 700s and 800s now, then your access to lenders is much wider, and you have the power of negotiating your mortgage product and your mortgage rate and term. So it's really access to money is what it boils down to when it comes to the credit rate. And here in North America, credit scores and credit rating and use of credit is very, very important. Not too sure if they have the same process in Jamaica now. Your access to equity in your home in the least expensive manner is highly incumbent on the quality of your credit rating.
That was very informative, Ray. Thank you so much. I learned a lot. So
Okay.
a lot of the stuff that you told me, we don't have access to those in Jamaica. I wanted to thank you. We're running out of time, but I wanted to thank you so much teaching us all about refinancing your home to purchase a home in Jamaica. The options you gave us: selling, refinancing, taking a home equity line of credit, or a reverse mortgage. So thank you so much, Ray. We'll keep the conversation going.
Thank you very much. It's been a pleasure. Thanks a lot, Paula.
Thank you so much.
Take care.
You too.
Bye-bye.
Bye.